Everybody, Dave here in Freedom Investing. In today's video, we're going to go over Cisco systems. We're going to look at Q4 for 2020, the results. We are also going to look at the fiscal year 2020 and also look at the guidance for Q1 and possibly for fiscal year 2021. So they just finished their 2020 and they gave guidance, and that caused Cisco to sell off. But was there something else there that caused the sell-off? So I kind of dug into it, and I'll just give you my opinion. So let's go ahead and get started. The information expressed in this video is my opinion, and my opinion only. This information is for entertainment purposes only. Please do your own research. Here we are looking at the Cisco report fourth quarter and fiscal year 2020 earnings. And what we do here, what we have here is Q4 results, revenue of $12.2 billion. That's a decrease from 9% of year over year. And we also have fiscal year 2020 results, revenue of $49 billion. That's a decrease of 5% year over year. 51% of that revenue came from software and services. They talked about that on the earnings call. I did listen to their whole earnings call and try to get an idea of what caused the actual stock to sell off. So what I believe caused the stock to sell off was this right here. Q1 guidance going forward. So revenue, they're looking at a loss of 9 to 11% decline year over year from 2020. We are still in 2020 obviously, but their fiscal year runs differently than what a calendar year is and all that. So if we look at the other earnings slides here, we got a breakdown of the different products. Infrastructure platforms got a decrease of 16% year over year. Applications down 9% year over year. Security went up 10% year over year. Other products down 17% year over year. And then you got services, which remained kind of flat. On the earnings call, they did say that they did have quite a bit of pickup in their Webex platform. Obviously, Zoom is killing it right now. So why wouldn't Cisco? Well, Cisco has a lot of different product categories, hardware, software, security, cloud, 5G. So there's a lot of different things there that aren't doing as well as, say, just security products or things like Webex. Okay, now granted, there's a lot different options than Webex these days. Okay, so you have Blue Jeans, you have Zoom, you have Teams, which is kind of become popular lately. My customers switch from Blue Jeans to Teams. I hate Teams personally, but I am a fan of Webex. My company used Webex for several years. They have recently switched to Zoom in the last, I'd say, year or two. And I'm hoping that they don't end up going to Teams, because I just don't really like Teams. If you've used Zoom, it's killer. So I think that is part of the issue there is, people did pick up the Webex product a lot over the last, since this whole beer virus started and all that. But, there's a lot of other choices out there now too. So with that said, they did see an increase of software subscriptions, pick it up, and free trials and all that. But it wasn't enough to offset a lot of this other stuff that is their core products. What they did mention on the conference call is they did mention that a lot of the large enterprise companies didn't cut back so much on their CapEx spending, so they did see a decent amount of spending there. But what they did see is a decline in the small enterprise, the small business, the startups, and all that. So that is where they lost a little bit of the revenue from. A lot of the companies, the bigger companies that can survive this pandemic, or just went ahead and forward to upgrade their infrastructure. But whereas some of the smaller companies, they got to put out a lot of capital going forward, and they don't even know where they're going to be standing at the end of the pandemic. So they're just holding back on that spending right now. If you think about it, if you have some old Cat switches in there, some old Nexus switches in there, the older generation stuff, you could run on that stuff for another couple years. I don't think any of this stuff is end of life unless you're on some really, really old stuff. But so that companies can really just push this off to the end of the pandemic till next year. and not upgrade anything like that. So that's the reason why Q1 guidance for 2021 fiscal year for Cisco is a little weak. They just don't know, what the customer is going to do, or their customer in this case here, they don't know what they're really going to do, and that's where they make a bulk of their money from. And those security products, whether they picked up, Webex picked up, it's just not enough to make up for the infrastructure platforms. So looking at the numbers here, $179 billion company, and we also have sales about $49 billion, 75,000 employees. We do pay a dividend of 3.4%, gross profit margin 64%, operating margin 28%, and profit margin at 22%. It does have a pretty low beta considering, say, a tech company. Year to date, we are down 11%. So if we're going to look at Seeking Alpha here, dividend yield 3.44%. Payout ratio 46%, that's pretty low. And then we have a 5-year growth rate, which is pretty good. It's right in between what a growth company is and a dividend company is. Like Microsoft might have a pretty high CAGR, but it might be a super low dividend yield. And we got a consecutive dividend growth of 9 years. So if you want to save Cisco from falling off that bridge, go ahead and like and subscribe and set that bell notification. Cisco has come a long way since I started working with Cisco products back in about year 2000. When I first started my IT, switched over from a company and went over to the IT realm. And Cisco was, heavy into switching, heavy into routing, and they've diversified their products quite a bit since then. They're in server space now, 5G. They're in, they have a lot of software offerings now. I was on their web page the other day, and it was pretty amazing the amount of products they actually have that are outside of just, physical hardware. They are in servers now, UCS products. They make some popular Blade products, Blade servers. They make some Blade chassis. They make some pizza pan servers, which are just a little one use. My customer, got rid of all their HP blades and, the C7000 blade system and all that, and went to, Cisco several years ago. So they have, diversified quite a bit. And in order to really benefit during a pandemic, in my opinion, they have to be diversified more. With that said, if they weren't diversified at all, they would have even been hit more. So, yes, they could probably diversify even going forward, even some more software products and all that. But, it's just, you can only go so fast, right? I mean, so during this pandemic, they did do pretty well, all things considered. With the diversification of the products over the last several years, last 5 years or so, maybe even more than that, their software products have helped them up. They did see a major increase in their subscription levels and all that, but it just wasn't enough to overcome that whole hardware venture. So we did talk about this. The market cap was it says on here 176 billion. On the other website it was 179. We have total debt about 14 billion, and we get cash of 29 billion. Now don't let this cash fool you here. Okay, so that cash can be a mix of cash that they actually have, and it can also be cash in short-term investments. And you can see that on some other websites. Right here, I'm just on Wall Street Journal, and this has a breakdown of their balance sheet or financials. And here's the cash only, so they have $11 billion in cash and then $17 billion in short-term investments. Now they talked about that on CNBC today. All these companies that are cash rich, well, are they really cash rich? They're in bonds and short-term investments. Then maybe they can't convert that to cash very quickly, so they're not really as cash rich as you think. They did talk about that in CNBC today. If you want to check out that snippet, today is August 20th. But at any rate, they do have about $29 billion in cash, and 17 billion of that is short-term investments. That could be bonds and some other makeup as well. So after the sell-off, after the Q1 earnings, I did listen to the earnings call, and there was nothing glaring in the earnings call. It's just the major reason it sold off was just because of the weak guidance going forward for not Q1, but also for fiscal year 2021. But there was nothing in there that was operational, an issue with Cisco itself. Like I said, they could diversify more down the road. They would be a little bit more set up for a pandemic or something like this, where CapEx gets cut back. So other than that, that's what caused the sell-off, in my opinion. And now it did gap down and then sell off for the whole, basically for all last week or after the earnings. And earnings was August 12th after market close. So where is the stock going to be going? So in my opinion, it's sitting on a pretty good support level right now. If you look back here, back in April and May, and we did have quite a bit of pop today, a little 1%er. But in my opinion, I would be looking to buy this probably around 40. Now I already do own Cisco right now. So if we look here at my dividend portfolio and we scroll up here, let's see. Okay, so here's Cisco right here. So I do own Cisco. My cost basis is $43.64. And I'm down 3%, and that's, I have two different accounts here that are combined. So one's taxable, one's tax deferred, and then this is the aggregate. So we are down 3%. And literally I was just up last week on this particular stock, but I'm not going to be adding till the stock gets down to about 40, somewhere around 40. This is where I probably pick up more shares. So I do own 103 shares at this time, and like I said, I'd probably be looking to pick up some shares about around 40 or so. So the weak guidance that they gave, most of the issues have to do with this CapEx spending from the enterprise customers, the small business and the medium-sized business, and maybe even the small enterprise. The larger enterprise did still spend. Like I said, the customer that I support, they're still spending with Cisco and all that. So the biggest issue is the smaller enterprise, the medium to small business. They're just going to continue to run on a lot of their older equipment for maybe another year or two, try to squeeze out as much as they can before they upgrade some of their core products and infrastructure. So at this point, is Cisco a buy, or should we throw this thing off a bridge? Like I said, I would probably buy it around 40, maybe even sub 41, somewhere between 40 and 41. So in my opinion, it's not a buy right now, and obviously this is just my opinion only, so do your own research, obviously. And just as a kind of a thing to note here, Cisco is the first company that I ever invested in my own brokerage account back in 2001. Very first company ever bought. Cisco is very popular. They dominated the networking field. And they did buy Meraki, and I believe that they got sued by Arista as well, and I think they even collected like $400 million from Arista, I think last year, and I think that showed in the balance sheet as well. If you didn't see the video last week, that was on Intel. I did buy over $50,000, about $50,000 worth of Intel last week, 1,000 shares. So go ahead and take a look at that video. It's up here. And right now, we'll see how this stock plays out and going forward, and whether I'm going to buy it. So that's it with this video. Go ahead and leave a comment below if you have any comments, questions, or concerns. Go ahead and hit me up on Instagram, Facebook, Twitter. I'm also on Reddit as well. You can go ahead and DM me, you can email me, doesn't matter. I'll go ahead and respond to any method you want to contact me if you have any questions. And let's go ahead and end the video here. So go ahead and like and subscribe. We'll see you in the next video. Thanks for watching.